these volatility skews. There's also an alternative construction. There is a way of constructing this differently. And here it is. The one you've heard of so often, near and dear to your hearts, ladies and gentlemen, the short iron butterfly. Now, all the other butterflies we talked about, the put and the call, the conventional butterfly, all puts, all calls, they were called long. Why were they called long? Because they were a debit trade. You had to put money out, a debit. The equivalent to those is the short iron butterfly. Why is this one called short? No difference in what they do. No difference at all in what they do. And you're going to see me prove that in a couple minutes. The difference is the way this works, it sets up a credit. That's all. One's a debit, one's a credit. But we already know that that means nothing for premium collection. Premium collection has nothing to do with debit and credit. This is a perfect example. The conventional butterflies, long, versus their synthetic, yes, synthetic counterpart, the short butterfly, the short iron butterfly. Now, you might say, well, I don't get it. Go back to what you learned about vertical spreads. We knew that buying the call spread was the same thing as selling the corresponding put spread. They were synthetic equivalents. They worked identically. One was just a debit, the other was just a credit. Both were going to make the same amount of money and have the same risk at the same price levels as each other. The only difference that separated them was one was a debit, the other's a credit. Your iron butterflies relationship to your conventional call and your conventional put butterflies are the exact same thing. This is the same trade as the conventional butterfly. It's the same thing as the conventional call butterfly. It's the same thing as the conventional call butterfly's synthetic partner, the conventional put butterfly. The short iron is synthetic to both of those. They're all the same doggone trade. Just one's a debit, the other's a credit. That's it. And you're going to see how that's true. Now, when you look at the short iron butterfly, you have another way of looking at this. We're not only looking at two spreads here, two conflicting vertical spreads, we're also looking at strangle versus straddle. What we have here is a situation where, remember, we said we wanted to sell that straddle. But the problem with selling the straddle is it wasn't hedged. The iron butterfly says, tell you what, sell your straddle. Sell that at the money call and sell its corresponding put. Sell your straddle. You want to know why? We're going to strangle that straddle. We're going to buy an out-of-the-money put to the downside, and we're going to buy an out-of-the-money call to the upside. That out-of-the-money call is now going to protect your short call from your straddle if the stock goes up, and that out-of-the-money put that you're long is going to protect the short put of your short straddle. That's all it's doing. We're selling this straddle at the money and buying a strangle out of the money around it. The strangle is your hedge to your short straddle. Strangle the straddle. Here's our straddle. Let's put a long strangle around it. That is what we're doing. We're short that straddle, and we're long a strangle around it. The strangle is our protection. Now, obviously, the strangle is going to cost us some money. And that means that our iron butterfly, along with our conventional call butterfly and our conventional put butterfly, will not collect as much premium as the short straddle could. Oh, well, the difference is that strangle that you're buying around the straddle, that long strangle is your life insurance policy. And believe it or not, I really mean life insurance policy. I'm not talking about the life insurance policy for your portfolio. I'm talking about your life insurance policy for your life. Because if you sell a straddle naked and you have to tell your significant other who walks in the door after a long day's work saying that their entire life savings is gone due to your incompetence, you're going to die because they're going to kill you. So this is a life insurance policy. Theta of your short straddle is going to exceed the theta of the long strangle. Your short straddle is going to give you a lot of short extrinsic value, the type that decays and you collect. The strangle that you buy around it, out of the money options, they're going to have smaller extrinsic values. And because they have smaller extrinsic values, the straddle is going to lose a lot more than the strangle. There lies your profit. Theta's highest at the money. We're short 2 of the at the money options. Theta's lower as you go either in the money or out of the money. We're going to have 2 out of the money options here. We also can set this up as 2 conflicting vertical spreads, just like the conventional butterflies. Here's the difference. In our conventional butterflies, we're going to have 2 vertical spreads, one long, the other short. In the iron butterfly, we're going to have 2 vertical spreads, both being short. Remember, think about your conventional butterfly. Think about that call butterfly. We were long the 60-65 call spread and short the 65-70. But we know that that long 65 call vertical spread is the same thing as being short the 60-65 put vertical. They're synthetic. All the iron butterfly is doing to the conventional butterfly is taking away your long vertical spread and substituting in the corresponding short vertical spread. That's what the iron butterfly is doing. That long vertical spread is creating, in the conventional butterfly, that long vertical spread is creating the fact that you have to pay a debit to do your conventional butterfly. If I take away that long vertical spread and substitute in its short counterpart, its short synthetic put spread, in that case, then I've taken away the debit. And what do I have? A credit. That's all we've done. All the short iron butterfly is, when you want to look at its vertical spreads, is I'm going into my conventional butterfly, I'm taking away the debit vertical spread, and I'm replacing it with the synthetic equivalent short vertical spread. Do that with either the call butterfly or the put butterfly, and you wind up with the short iron butterfly. That's all this is. It's just a synthetic reorganization of your conventional butterflies. Thus, it has to be equal to the others. Now let's take a look at the breakdown of our short iron butterfly. Over to the left, we just have the short iron butterfly. We're going to be long the June 60 put, long the June 70 call. And we're going to be short the June 65 call and short the June 65 put. And I gave it to you that way because look at the breakdown over here. Short the June 65 call, short the June 65 put. There's our short straddle. Long the June 60 put, long the June 70 call. What's that? There's our strangle around it. We can break down this iron butterfly, if we wish, to look at a short straddle surrounded by a long strangle. Or, take a look at what we have here, the iron butterfly again. Long the June 60 put, long the June 70 call. Short the June 65 put, short the June 65 call. Obviously that breaks down into a, what? Strangle, long strangle around a short straddle. It also breaks down, as I said, to 2 different spreads, vertical spreads. And I said that you can see how the iron butterfly simply takes the conventional butterfly, takes away the long vertical spread of the long conventional butterfly, and substitutes in a short vertical spread instead. What we have here is two converging credit spreads. We've got a short June 60-65 put spread, and we can see that by being short the June 65 puts and long the June 60 puts. And we've got a short June 65-70 call spread. Short the June 65 call, long the June 70 call. We've got two credit spreads. This is why the short iron butterfly is a credit trade, because we've got two credit spreads. We're bringing in a credit off of both spreads. In our conventional butterflies, we're only picking up a credit on one of the spreads. We've got a debit on the other. So that's all it is. They are all synthetically identical. Don't believe me? Let's play with some numbers straight off your sheets. Remember, we did the call butterfly, the June 60, 65, 70 call butterfly. We did the June 60, 65, 70 put butterfly. And just so you know the lingo, what you do is if you're talking about a butterfly, you don't have to say, oh, I did the June 60, 65, 70 butterfly. It's just the June 65 fly. That's it. Take that middle strike. That's the name of it, the June 65 fly. So anyway, here's our short June 65 iron butterfly. We are long the June 60 put, 18 cents, and long the June 70 call, 39 cents. So you know on your sheets, this is sheet number 1, these values are coming from. And we're looking at June with the stock at 65.50. We're putting out 18 cents and putting out 39 cents. Those are our two long options. We're bringing in these short two options. Short the June 65 put, $1.48. Short the June 65 call, $2.04. What is our credit here? $2.95. Since we're selling this, what's the most we can make when we sell something? The amount we sold it for, $2.95. Go back and check what the maximum value of the call butterfly and the put butterfly were, the maximum profit. Go ahead, I'll wait. What do you see? All three of them have a maximum potential profit of $2.95. Now, if we know that this butterfly has a maximum value of 5 and we're selling it for $2.95, what would be our maximum potential loss? $2.05. That is correct. This iron butterfly has a maximum profit of what we sold it for, $2.95, and a maximum potential loss of the full value of the butterfly, $5, minus the credit, minus what we sold it for, which is $2.05. Our maximum loss here is $2.05. Go back to the conventional butterflies, the call and put. Don't both of them have a maximum potential loss of $2.05? And doesn't that loss of $2.05 happen at either the long strike to the downside or the long strike to the upside? Just like here? This goes to prove that our short iron butterfly is synthetically identical to our conventional call butterfly, which is synthetically identical to our conventional put butterfly. All three make the same amount and lose the same amount at the same exact spots. All three have the exact same Greeks. They are synthetical equivalent positions. These are synthetical. They are perfectly equalized. Check it out for yourself. I've just showed you the example in June. Go into July and run through this. Do the call conventional butterfly, do the put conventional butterfly, and then do the short iron butterfly. The numbers come up the same every time. It's because all three of these trades are identical. If they're identical, then they should have an equivalent price. Buying the conventional put butterfly for 205 is the same as buying the conventional call butterfly for 205, which is the same as selling the iron butterfly for 295. Now that we have an equivalent price between the three, we could tell if one's out of line or not. And if one's out of line, that's the one we want to do. We want to do the cheaper one, not the more expensive out of line one, the cheaper one. When we're buying the conventionals, the more expensive one, if we wind up finding out that our short iron butterflies net credit is out of line over on our debit of the call and put butterflies. Let's take a look about how we find a consolidation, because after all, this trade here really does its best work when the stock is trading sideways in a consolidation type pattern. And that's when we want to use these butterflies. So let's take another look at how we find a consolidation on the charts. So do you like the butterfly?
I love it. The straddle and the strangle. Very cool.
And you can also look at it as two vertical spreads also.
Right. Well, you know what
Both
I like
have
about,
limited loss.
Yeah, exactly. Well, you're hedged in this case. And a lot of
Exactly.
times I understand why people would be tempted to short a straddle, because you're basically taking in premium from both sides. But in this case, you're not, going to lose sleep at night worrying about losing your whole account if the company gets bought out, or if, they
Bad earnings. You remember there's the other. Yeah, there's the other direction too. No matter where it goes,
right.
You're going to feel some pain, and if you get beat on this thing, it's normally big and it's normally ugly.
Right. So now they have a strategy where they can profit from a stock's movement, the type of movement that a stock makes 80% of the time, which is sideways.
Yeah, which is no movement.
This is what they're going to see most of the time.
Exactly. And what they're doing is they're giving up a little bit of the proceeds that they're bringing in from selling the at the monies to buy an out of the money in each direction for protection.
That's not a lot to ask, is it?
No, not at all. But what we need is a consolidation.
All right. Another consolidation.
I know you're getting bored with that, but we need to find another consolidation.
Well, the consolidation is a boring little pattern there, but it's the pattern that we see most often.
Well, you know what? And if you're using a butterfly, with the type of money that you could be bringing in with the amount of risk you're putting forth, I could be bored often.
Right.
I'd like to be bored.
We have to also remember that, when you're using the butterfly, you're collecting premium. So essentially what you're doing is it's kind of like a covered call or a diagonal spread. You're collecting premium. So this is something that you can basically do every single month. And it might be 1 or 2% or 3%, but what you're doing is every single month you multiply that by 12. You compound that, and you're beating the market by a lot.
Almost in every year, too.
In a perfect world.
Yep, that's exactly right. And
when will the world be perfect, Ron?
As soon as these people learn how to find a consolidation and apply the butterfly to it.
I can take a hint, Ron.
I got you.
All right. Well, I'll go show them that.
I appreciate that.
All right. So for the butterfly, what we're going to be looking for is a consolidation pattern. Remember, in the strangle that we went over, first we saw a consolidation pattern, and that's when we prepared our position, because we were looking for the breakout, and the breakout is what we were going to profit from. But here with the butterfly, what we're doing is we're taking advantage of the consolidation itself, and that's what we want to find. So I'm going to show you how to identify when that's most likely to happen. Let's take a quick look. Here's Teva Pharmaceutical Industries, a pretty well-known company. And the first thing we want to do, what do we want to do first? Identify key price points, support and resistance. You can see here there are a bunch of lower tops. The stock starts to break down right at this point. And at these lower tops, you could basically draw a line and find a downtrend line. And this is a good way to find reversals, and a reversal could just be a change in the trend. So a reversal and a downtrend could be an uptrend, or it could just be a sideways consolidation. But what you have here is a downtrend. We've identified it. We connected this high to the lower high, continuously to lower highs. But what happened was the stock finally broke through this downtrend, and you can see at one point the market was confused as to whether or not it wanted to do that, because we got all the way up to this point. Very small body in that candlestick pattern. That means there's indecision, happened to land right on that downtrend line. And remember, we said old support becomes new resistance, old resistance becomes new support. So this was a resistance level. Once we broke through this resistance level, it became the new support level. Market bounced right off of that same line. Now here's the weekly chart. Every single one of these is a week. You can see every one of these candlesticks represents 5 trading days. I just wanted to zoom out for you because here, let's go back to the daily chart. You can see this only goes to October. I want to show you why you could have identified the fact that these support levels and these resistance levels were going to occur, or that they were likely to occur. All right, so we pull up the weekly chart, and we find right here that the market bounced once, twice, again a third time right here. It's hard to tell because this is 5 days of trading, but it bounced at that point. And it's no coincidence that once it broke that point, the market pretty much fell from about $42 a share down to $36. So we identify that key price point, and we're going to remember it when we zoom back in. But you just remember that this is at about $42 per share. So the old support level becomes a new resistance level. Again, this is a month worth of trading right here. So don't lose sight of that. You only see 3 candlesticks here. But you could see that this became the new resistance level, although it was the old support level. So if you extend this a little bit further out, you're going to find that this is the new support level. Other things that jump out right away, right here, you could find some support. This is 3 weeks. This is 15 trading days. So we draw a line right there. And what you've got is a channel. So when the market's crashing and everybody's heading for the hills and options become more expensive because people are into protecting themselves and hedging by trading options, they finally realize that options are the best place to find safety. Options become more expensive because everybody and their mother wants to buy them. What you want to do is you want to take advantage of the fact that options are overpriced, and then eventually people are going to get their sanity back. So you look for a consolidation pattern. After a big market crash, things tend to calm down. So these old support levels that you see here for 3 weeks become new resistance levels over here, and it goes on for months. And when you extend these key price points out, you find that you're going to find resistance where you're going to find support where the old resistance was right here. So that's how you identify this first channel. There's another channel right here. This is going to be the channel that you're going to want to take most advantage of. This is where you're going to make the most money because it came after such a violent decline from about $49 a share all the way down to $36. You've got a 13-point drop here in just a couple weeks. So when the market rallies back up and finds resistance at the old support level, you know that's probably going to be one of the best places to identify your channel. At this point, the market already kind of consolidated, and it broke out again. Options are not going to be as expensive here, so you're not going to make as much money on this consolidation. But you'll be able to identify that consolidation. I'll show you how in just a second. Remember, here we found support for 3 weeks. At the same time, they found resistance right around the same levels, and we'll zoom into the daily chart in just a minute. But if you just extend that out, you find that that's where the resistance is going to be right here. That's how you're going to identify your next channel. You might find another one after a breakout through this level where this major resistance was at this top. So now we're just zooming in a little bit here, and you can remember that 44 was one of our key price points. You can see that this was the ideal time right here to start shorting volatility. Once we broke through that level, you can see this is a pretty confident breakout. You can see you have about two times the average daily volume for the last 50 days. Once you get that breakout, you see very small bodies in these candlesticks, some indecision. And what you wait for is to see if this is a false breakout or not. Because if it's a false breakout, you'll probably see the market start to trade a lot lower and then find resistance at the same level. But instead, it traded lower, found some support, and then tested that support time after time. Every time it tests the support, that support level becomes more powerful. So let's go back here and study some of the small details that you can find that led up to this breakdown. And remember, you want to be prepared when you're trading options or when you're trading stock. So you want to try to see these things before they happen. So when you see this breakdown start to happen, a lot of other people also see the same exact thing. So what you want to do is try to think one step ahead of everybody else. You know that if these key price points are broken, you know that people are going to be heading for the hills. They're going to be frightened. And knowing that people are going to be frightened, you then know that option prices are probably going to get very expensive. It's going to be overpriced. So when you're thinking one step ahead and you already see this breakdown, you know that option prices are going to go up. you might be a little bit late to take advantage of this breakdown. However, you know people are so scared and option prices are going to be too high, you could take advantage of the fact that option prices are going to be too high. And that's when you start to implement your strategy. So you see here, you have a little bit of support. However, that support was broken with this long red candlestick. It's a down day. You can see it happen again right here. So if this one didn't give you enough confidence to get bearish or prepare for this opportunity to short volatility right here, this one certainly confirmed what you thought originally. So you see this little bit level of support right here that was eventually cracked. You could see that that became the new resistance where these two small arrows point to the intraday highs of these 2 days on these two candlesticks that have these small bodies that you see right here. So the market tried to rally back up through this old support level, couldn't do it. Sure enough, it acted as resistance, and you can extend that process all the way out. So you find these little details and notice how it became such an important factor in identifying this consolidation and then the second consolidation right up here. So we found one more key price point right here. If you look very carefully, you could see when we're talking about key price points, we want to look at intraday highs and lows, and we also want to look at the close. When we're going horizontal, the close is the most important part of the day. You can see the market closed when it tried to rally up with this green candlestick. Didn't make it, found resistance right there. You could also see that at this point the market opened at that same resistance point and got slammed on very heavy volume. So you knew that once that happened, I mean, this is a very volatile day. This is probably the day that options became the most expensive. Once that happened, you could see that there was resistance right at this same blue line where the market kind of tried to rally through it and then it failed. This is where options are going to start to become cheaper, right around here, because what you did is you confirmed that there was some support right at this level. Before there's any confirmation, people are still scared because nobody knows what's going to happen next. Once this was tested a couple times, people start to feel more confident with it. After seeing this big resistance right here several days in a row, they start to find that they feel a little bit more confident once they get this bounce that you're looking at right here. A couple more things that I want to point out. The market tried to rally and found resistance right here 4 or 5 times, key times. Then you can see it happened probably 10 plus times here. I don't even think all the arrows are pointing all the times when we found resistance right at this level. You'll also notice that when the market rallied up, it wasn't validated by heavy volume. So anytime the market tried to get past this key point, there's very light volume. So these are all the clues, because remember, when you're looking at the chart, you don't see all this right here. What you see is just from here and to the left. So you're trying to guess that all this is going to happen. All you have right now is this information that you see right here. So when you know that this is a key price point because of this past support that you saw here, and then resistance here and here, then you start looking at the volume, and that's all you have to work with. But that's enough in terms of clues on consolidation, especially since volatility was probably so high and options were so expensive. And that's what you ended up with. You ended up with the second consolidation, which was the more obvious one. The first one was a little bit harder to detect, but this is the one where you made the most money. So that's how you identify a consolidation pattern, which is ideal for the butterfly strategy. First, you see a ton of volatility here, which means options are expensive, and right here is where the options are going to start to decline in price. And that's what you look for when you try to find a consolidation pattern for the butterfly strategy.
To see how Ron selects options that match Chris's strategy, visit the members section at optionsgps.com.
Well, how'd I do?
You did outstandingly. Outstanding. The thing is, I really like how you show in a real quick, easy manner how to find these consolidations early. That's the key, finding them early.
Well, that's what's important. I mean, you know, once the consolidation pattern is established, everybody in the world knows about it.
Right.
You're not going to be able to get the best price on the options that you're looking for.
Volatility have already been come in, and
Right.
you know, you're not going to have the opportunity that you had
Right.
if you would have found it earlier.
And as we know, stocks can consolidate after a breakout or after a breakdown. And after a breakdown, that's when volatility is going to be the highest. So essentially, you're shorting volatility after a breakdown. So this might be a better strategy when we get a consolidation after a breakdown and volatility is starting to shrink a little bit. Might be a little bit bit better on that end. But it works in both cases, right?
That's exactly right. But like you said, the earlier you find this thing, the better price you're going to get on your butterfly. But, you know, remember, you're in a consolidation, and at some point in time, everything ends.
Right.
And the consolidation at one point will end. And when it does end, it's either going to end in a breakout or a breakdown. We don't know which one.
Right.
But we're going to get one or the other. And the nice thing about the butterfly is where we've talked about it being a short straddle versus a long strangle around it, it's also broken down to two vertical spreads, one being a bull, the other being a bear. And the nice thing is that means we can easily trade this new directional movement out of our butterfly by simply morphing.
Okay, well, eventually the stock is going to break out or break down. Just one last rule that I didn't cover in the technical analysis that I was just showing them was that, you know, a general rule of thumb is that the longer the consolidation, the longer the base, the bigger the breakout or breakdown when it actually does happen. So keep that in mind. It's like a time bomb. You know, you can find the consolidation early on in the pattern, maybe even just after the pattern, but you don't really want to play with a consolidation that's been in place for several months or anything like that, because after you build a nice long base, once you get a breakout, it's a much bigger deal, or a breakdown.
And that little tidbit is extremely important. I'm glad you brought it up, because this is something that a lot of people don't know, is that after we see that directional breakout is occurring and we get into our bull spread or bear spread, you have now an opportunity, if that is a bigger breakout or breakdown, to simply go into a stock replacement strategy very quickly out of your spread. So if you know you're dealing with a longer base, as Chris said, and you have a spread on now, because we've gotten out of the butterfly for the directional movement, we have a very easy morph into stock replacement from there. Well, then now that we're able to identify a consolidation, if we do run into one that we want to try to take advantage of, we need to now set up our butterfly. So what we do is we find that consolidation pattern. And if by chance we were using it to trade a volatility skew, we would find a volatility smile that was either too peaked or too flat that we know is going to at some point in time revert to its mean. But for right now, we're talking about charting patterns. We found our consolidation. Now it's time to put on the butterfly. Now, do understand, a lot of people trade these butterflies not as a whole. They might be in a vertical spread following the movement of a stock. And now that the stock has stopped and starts consolidating, they quickly sell another vertical spread to get into the butterfly to play the upcoming consolidation. Remember, most stocks that break out, they make their run and they run up and establish a new high end of the new range. Then they retract to establish the low end of that new range. Then they start their sidewards consolidation pattern until it's time for them to either run back up or run down to establish a new range. So a lot of people are in a vertical spread. The stock is traded up. They don't want to necessarily get out. They see a consolidation approaching, and now they've already got one vertical spread on. All they have to do is put on the other, and boom, they are in a butterfly playing the consolidation. So do understand that a lot of these times, these butterflies are vertical spreads that go from being a vertical spread, they leg into, by doing another vertical spread, the butterfly. So you're in a debit spread, stock runs up. What are you going to do? You're going to do the credit spread. If you're in a credit spread, stock runs up, you're going to do the debit spread. You're going to lock in your butterfly. Or if you're in a credit spread, you sell the other credit spread, and you are in your short iron butterfly. So do understand that quite often the butterfly is not something that's put on as a whole. It can be, not a problem. But sometimes it's legged into. What are the keys to success of the butterfly? If you notice, I always have this bullet point up here, and you're probably getting tired of it. Good, that's why it's there. Because this is the key. I don't care how good of an option trader you are. If you don't have a good idea of what the stock is likely to do, you're going to have trouble putting on the right position. No matter what you're doing, not just in options. Not just in options. If you don't know where the stock's going and you buy the stock and it goes down, you lose. We need to have good, solid technical and fundamental analysis of the stock. The stock is going to dictate what's going to happen in the options. If I already know what's going to happen in the options, then I can look at the options market now, look at what maybe price discrepancies there are, and take advantage of that, knowing what is more than likely going to happen in the stock and how that's going to affect the options. Understand something. Premium collection is all about extrinsic value and the decay of that extrinsic value, which is known as theta. Skip the whole debit credit crap. It's not true. It doesn't work. When we talk about premium collection, you've got to be talking about time decay. The decay of extrinsic value over time, and that means theta. That's why the Greeks are important. The butterfly itself is a combination of two vertical spreads. Don't get yourself all whacked out trying to, I don't understand this whole butterfly. Understand the nature of the two vertical spreads first. This is why I said the vertical spread was a very important strategy. Not only is it directional, but it's premium collection to boot if you set it up right. If you set it up right, premium collection, you can do two verticals, one up, one down, one credit, one debit, sometimes two credits, and set up a premium collection position known as the butterfly. So if you understand verticals, it's a lot easier to then understand the butterfly. Understand that long call, long put, and short iron are synthetically identical. And theta is the key. That's why you should know thy Greeks. We are talking about premium collection in a delta neutral strategy. There is no stock direction we're talking about here. This is delta neutral. This stock makes money off time decay, theta. So let's talk about, now that we've got this butterfly on, how are we going to trade it? Well, what happens if the stock goes up? Well, obviously, it's senseless to roll the butterfly, a non-delta or delta neutral trade. If the stock goes up, that means it's moving. We need delta. Rolling the whole butterfly doesn't do anything for us. But we know that there's two components in a butterfly. There's a bull spread and a bear spread. Don't worry about which one's debit, which one's credit, doesn't matter. You have a bull spread and a bear spread in every single butterfly. That's why it's delta neutral. If you had two bull spreads, then you'd be delta long and you couldn't have a butterfly. If you had two bear spreads, then you'd be delta short and you couldn't have a butterfly. Each of the three versions of the butterfly have a bear spread and a bull spread. Do not get that confused with debit and credit, because there's a debit bull spread and a credit bull spread. There's a debit bear spread and a credit bear spread. But each of these butterflies is a bear spread, which is directional down, and a bull spread, which is directional up. Closing out, we can always close out anything that's not working for us when in doubt. So, what if the stock goes up? Here we are in a call butterfly. Two vertical spreads, a bull and a bear. Which would we like to have if the stock was going up? The bull spread, right? Come on, that was easy. I give you easy ones every once in a while. The bull spread. And we have a bull spread in here. We're long the June 60 call, short the June 65 call. That's a bull spread. This here is a bear spread. With the stock running up, it's the bear spread that's ruining our life. We need to get rid of that bear spread. Now, here's the thing. If by chance you're feeling pretty good about this upward movement, instead of just getting rid of this bear spread, you could leave this call alone and just buy back that call there. Now you've got a bull spread working for you, and if the stock really starts getting excited, you've got this call right here that'll help you too. So normally, the normal morph, just take off the bear spread, and we're left with a bull spread. However, if you're feeling good about yourself, you feel good about, hey, It's now breaking out of this consolidation. It's breaking out to the upside. Just buy back your short June 65 call. That's all you got to do. And once you do that, look at yourself. You're in a bull spread plus an extra call to the upside. What if I was in the put butterfly? Well, I still have a bear spread and a bull spread, don't I? Yes, I do. So what am I going to do? I'm going to find that bull spread, identify it, and leave it. Where is it? It's right here. It's the 65.70. This short put spread here, this short put spread here is what? A bull spread. We've got a bull spread in there. We've got a bear spread in there. The stock is going up. Which one do we want to have? We want to have the bull spread. Get rid of the bear spread. Simple. Now that we get rid of the bear spread, we're riding a bull spread. How about the iron? Bull spread and bear spread in here too. These are two credit spreads, aren't they? In the iron, the difference between the iron and the conventional call and put is the conventional call and put have a debit spread and a credit spread. The iron uses its knowledge of synthetics, gets rid of that debit spread, and substitutes in its synthetic credit spread counterpart. So we've gotten rid of the debit spread. We got two credit spreads here in the iron. But still, one bull, one bear. That always exists here. Identify the bull spread. Identify the bear spread. Know which one is which. And then get rid of the bear spread and ride the bull spread. Now, what if the stock goes down? Pretty much same thing in the other direction. When the stock was going up, we were saying get rid of that bear spread and ride the bull spread. Here, we're going to do the opposite. Now that the stock is going down, it's the bear spread that helps us. The bull spread is in our way. What are we going to do? We're going to close out the bull spread and ride the bear spread. Again, if we're just in doubt and we're saying, I thought it was a consolidation, I read this thing wrong, my confidence is terrible, I want to slit my wrists, I'm the worst trader in the world, and you're going through that whole psychological problem garbage, then just close the doggone thing out. But if you understand that losses are part of the game sometimes, and you could take this opportunity to say, hey, it was consolidating, and now it's going down, this is a breakdown, it's a good opportunity for me. What can I do to get this butterfly in line? Here's our call butterfly. We've got a debit spread and a credit spread, but more importantly, one's a bull, the other's a bear. We don't want the bull spread this time. We want the bear. Stock's going down. Identify your bull spread and get rid of it and ride the bear spread on the way down. And as you're riding your bear spread on the way down, do me a favor, and this is true for the other morph also. Once we are in the butterfly and we morph into either a bull spread or bear spread because of a directional move, start remembering your bull spread and bear spread. Once we get out of this butterfly and we put ourselves into one of the verticals, trade it like it's a vertical now. We've got another morph we can do here, isn't there? If the stock really starts trading down, we know this bear spread is limited. It's a hell of a lot better than the butterfly we had on. The butterfly we had on, we were looking at losses. Now that we're in a bear spread, we're now at least looking at gains, but we know the bear spread is limited. The butterfly is over. It's done. It's gone. Finito. We are now in a bear spread. Trade the bear spread in the breakdown. We have morphs to help us go from this limited, restrictive profit trade to something that opens up that limit again, don't we? Go back and review. I'm in a butterfly. From the butterfly, I know my morphs into my bull and bear spreads. If the stock starts running up, I get rid of my bear spread, I got my bull spread. If the stock starts going down, I get rid of my bull spread, I got my bear spread. But now that we've done that, we're now in a vertical spread. Trade it like a vertical spread. If the stock really starts going down, morph your bear spread. We know how to do that. Make sure you review that because that's the new position you're in. What if we're in the put butterfly? Well, we got a debit spread, we got a credit spread. Who cares? We got a bull spread and a bear spread. Stock is going down. What are we going to do? Well, we want to get rid of the bull spread. It's the bear spread that's helping us. Bull spread is hurting us. Get rid of the bull spread. Now trade the bear spread. But trade the bear spread. We hopped into here because the stock started going down. Suddenly it's gone down enough where it's breaking a major support. And as it's breaking the support level, we now have a breakdown. Think. Butterfly's gone. Ancient history. We are now in bear spread. Morph this doggone thing to take advantage of the breakdown. Get rid of that short put. Ride your long put in stock replacement. Remember, every time you morph a strategy from one to the other, the old strategy's got to be buried. You now have to trade this strategy. And this strategy says that when we break down, we buy back the short put and ride our long put like stock replacement. And once we're in stock replacement, we trade stock replacement. Roll the doggone thing. So we're in an iron butterfly. Stock starts going down. Hey, we've got two credit spreads here. Who cares? We've got a bull spread and a bear spread. We want to get rid of the bull spread. Boom, gone. We ride the bull spread down. And as the stock, we ride the bear spread down. We got rid of the bull spread. As the stock trades down, what are we going to do? We're going to treat this like a bear spread. And we're going to do the morphs of a bear spread if the stock breaks support. What if the stock stays still? We do nothing. We have a butterfly on. That's the idea. We're trading the stock staying still. If it's staying still, do nothing. It's doing nothing except making you money. Leave it alone. There's no morph here. There's no roll here. There's no closing alternative here. We're in the right strategy. Let it work for you. Stay patient. You have price points that you know if the stock exceeds to the upside, you know your morph. Get rid of my bear spread, hop into my bull spread. If the stock goes beyond even that and starts to break out, trade my bull spread and turn it into a stock replacement. No big deal. The nice thing about knowing all your moves and laying them out ahead of time is it eliminates panic. You're not panicked when something happens because you've already expected it and you already have made an allotment for it. I mean, I don't know if I've used this example before here, but it's like a great grand chess master, right? And you sit there and you say, that guy plays, you hear that saying, that guy plays six steps ahead or 8 steps ahead. Are you telling me that he knows what's going to happen before it happens? He can read my mind? Because if that's true, I'm going to stand up, I'm going to take the entire table and throw it over on him. He didn't react, did he? That's because he couldn't read my mind. He didn't read that, did he? He wasn't expecting that, did he? Fact is that he can't read minds. And you can't know the future either. What we can do, though, like that champion chess player, he can't read your mind to know your next move. He just knows all the moves you could make with a probability to you making that move. And from there, he knows what his response would be if you did make that move. That's all they're doing. They can't read the future. They don't know what you're going to do. So when they say he plays 6 moves ahead, that's because he's mapped out all the potential things you can do and what his response to that would be, and then what you could do off of that, and what his response would be to that. That's what you need to be here when we're talking about the markets. I don't know if the stock's going to go up, definitely, go down, definitely, or stay still, definitely. What I do know is, if it does do one or the other, if it does go up, I know immediately where I need to react because I've got that price point in the stock. Hey, if it goes up to here and it keeps going, I need to morph. And I know my morph. And then if it continues that way and it goes to here, I know my next morph. All I'm doing is laying out all the probable things the stock can do and what my reaction would be to it. And I can lay that out ahead of time. And with that trading plan, in a sense, I don't have to panic. I don't have to overreact. I simply execute based upon what the stock is going to do, because I don't know what it's going to do. I just know everything it can do. And knowing everything it can do, I know what my response would be no matter what it does do. And that allows you to be a lot more consistent, and it allows you to keep that whole psyche thing I hear about all the time in line. So, we have a call butterfly on. Leave it. Stock isn't moving. We're short the 2 at-the-money strikes. It's decaying rapidly. We're making money. Leave it alone. We're in the put butterfly. Again, short the 2 at-the-money strikes. Protection around. It's making money. Decay is clobbering my 2 short options. I'm making money. Leave it alone. I'm in my iron butterfly. Short 2 at-the-money options. My protection around. It's making money when the stock's not moving. Leave it alone. What I really want to hammer home to everyone is that, yes, there is a short butterfly, which is basically like a long straddle surrounded by a short straddle. A short strangle. The problem with all that is that if I ever buy a straddle, I need to have the ability to make in an unlimited fashion because I have a ton of decay. I've got huge break-evens. I need to have that unlimited ability to make money. That's why I never sell a conventional butterfly or buy an iron. The way I look at it is, and the way maybe as an investor you probably want to look at it, you want to be a buyer, you buy the straddle. You want to be a seller of the straddle, you buy the butterfly or you sell the iron butterfly. Those are the 2 opposites. You take these 2 strategies, the butterfly, take the premium collection side, long call, long put, short iron. That is your short straddle. Your long straddle comes from the real straddle. Buy the straddle. Don't sell 2 out-of-the-money options and limit your straddle. The idea of the straddle is, the only good thing about the straddle is, it's got unlimited potential in either direction. If that's your only advantage, why the hell do you want to sit there and chop that down? Long straddle, buy straddle, fine. You want to sell straddle, you do the butterfly.
Great job on the butterfly, Ron. Really, I mean that from the bottom of my heart. Anyway, we just covered the butterfly, and it's time to move right into the condor. Now, before you move into the condor, make sure you understand the butterfly. Go talk in the community at optionsgps.com, and make sure you have a good understanding of it. Challenge somebody. See if they understand it as well as you do. Take the quiz, pass the quiz, and then move on to the next DVD. I'll see you at the condor.
Okay, Chris selected TEVA for his butterfly. Consolidation pattern, sideways, perfect opportunity for a butterfly. And why a butterfly? Because the stock is directly at the strike. As you can see, the stock is trading at 42.19. And we just so happen to have a 42.5 strike. So how are we going to set this butterfly up? Easy. First thing we're going to do, we're going to remember premium collection. That means we need to be a seller of the at-the-money options. We are going to sell both the November 42.5 call and put. The November 42.5 call, 45-cent bid, we sell that. November 42.5 put, 80 bid, we sell that. So now we've got our 2 short options directly at that middle strike, which happens to be at the money. Now, that right there, as you know, is a short straddle. That right there is something that's probably going to get me a little mad at you, because you know you're not allowed to be naked short a straddle. So what do we have to do? We need protection. We need protection. How are we going to do it? Well, if we construct this butterfly in the credit style, which would be an iron butterfly, we sell that Nov 42.5 call, sell the Nov 42.5 put. Let's first find our protection for our short call. We're going to step up to the 45 strike to buy our call for protection. we're going to spend 15 cents, the offer, for our NOV 45 call. That gives us upside protection against our NOV 42.5 call. But we also need downside protection because we are short the NOV 42.5 put. What are we going to do? We're going to step down and take a look at the NOV 40 put, trading for 25 cents. That is the option we're going to buy. Now what do we have? We're long the NOV 40 put and the NOV 45 call. We've got a strangle. What are we short? We're short the NOV 42.5 call and put. Short the straddle. We just strangled our straddle. However, there are other ways of setting up the butterfly. We know that we could also do a straight call butterfly. If we were to go that way, again, we're going to sell the at-the-money strike. We've got to sell 2 of them. But we're going to use only calls. That means we need to sell 2 of the November 42.5 calls. We need to buy 1 of the NOV 40 calls and buy 1 of the NOV 45 calls. That will set up our +1, -2, +1 ratio that we need for our call butterfly. If we decide to go with the put butterfly, we come over to our puts. Again, we go to the at-the-money option. That's going to be the 42.5 strike. We need to sell 2 of the NOV 45 puts. We're going to buy 1 of the in-the-money NOV 45 puts, and we're going to buy 1 of the out-of-the-money NOV 40 puts. What do we have? We've got our +1, -2, +1 put butterfly. Now, as you know, all 3 of these butterflies I just described are synthetically equivalent. They should all be trading at the same price. Go through and take a look and find out which of these butterflies is out of line and that will give you the best price advantage.